Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Today we're going to talk about the outlook for NAR for both real estate and the economy for next year. It's pretty good.
We are. Okay, and for the person who commented on Todd's wardrobe, thank you for noticing. I will have you know that he has two different jackets. One is navy blue and one is black. The fact that this is lost in translation over the video, not my fault. But he does wear two different jackets.
I wear this most of the time. No, I wear this almost all the time. So if you're also noticing, we have a MacBook here. I usually have my iPad.
Right. Okay. So the iPad, that one's my fault. Apparently, my water bottle disemboweled itself all over Todd's iPad and fried it. So I apologize.
Yeah, that's right.
It's my fault.
I have to go in the Apple store and then beg them to help me with it. So we'll see.
Well,
but fortunately, we have the MacBook here, and I will be able to get through this. Okay.
We may be getting a new iPad.
Maybe getting a new iPad. Day after Christmas, we were going to actually do two videos to release today. We're going to do the national outlook for real estate, and then we're going to do a Vegas one because we have some really cool Vegas data that's a written summary of analysis by economists versus just the numbers. The problem is I found out that YouTube punishes channels if you reach two videos in a day. It's called subscriber burn.
Okay.
And they don't like it. It's kind of negative. And so what I'll do is we'll film that tomorrow and then we'll put it out. But it's a good video. It's good. We have good data on Vegas. Yeah. So if you want Vegas data specifically, subscribe to the channel.
Yes.
Okay. So this is the economic and real estate outlook. It's from Lawrence Yun, PhD. He's the senior, she's the chief economist and the guy who puts out all the economic data. It's basically all his job.
Right. So this is the guy that you see on MSNBC, CNN, Fox, wherever you get your news from. This is the poster child for NAR.
If you are a PhD in economics, you either do research for companies or you work as a professor at a university. Mm-hmm. So something to think about if you're likely to do that. Okay, here we go. The first slide. All right, Juana. This is the annual existing home sales. Mm-hmm. Now they're red. It's in red because it's this year. And it says F because it's estimating. When they did this data, they still had like a month to go. Mm-hmm. So they were estimating how many sales. It's pretty, obvious how many sales are going to be in the last month of the year. But this is going to be the worst year since 2008 or 95. So basically in the last 30 years, least number of home sales.
Right. So by worst, we mean least number of transactions, nothing having to do with price.
No, actually the home prices in probably 90% of markets in the U.S. and nationally overall the highest ever. Records were set this year.
Sure.
Even after last year when people said the housing market would crash, here we are with the highest ever. A couple markets, I think Vegas is about even. Boise is down. Austin's down.
Well, there are a bunch of places that are down. Is the point?
New York City's way up magically.
But most places are actually up. So
what's really interesting is if you go back all the way to the left, and you see those sub 4 million sales to the 90s, remember that the country was smaller and there were less houses. Vegas, I remember in the 80s, Vegas hadn't even hit 1 million people. Mm-hmm. Matter of fact, 1975, it was 265,000. No, it was 165,000. It was 165,000 people in 1975 in Vegas when I lived here. So the fact that home sales were down is because, even though interest rates were 16, 17, 18%, country was smaller, there were less houses, right? And less people.
Houses, less people. That's why there were less houses.
Yeah, and then you can see that first peak. That was what led to the housing crash. We got another chart that shows that really well. Okay. But that 4 million number, you should actually probably put on a slant because the country's gotten bigger. The number of sales, I think they put that there just to show you relative to years. Mm-hmm. It is actually much lower than 95 when you compare it to the size of the country.
Right.
So, right? Okay, now here's a good one. New home sales, they're up 4.5% from last year. It's on the track to be the third or fourth best year since the 2008, which was the housing crash. It was one of the housing crash years. It took multiple years for the housing crash. This is pretty substantial. Still only, according to this, like 600 and something thousand homes. That's not really a lot.
No, look, we're a country that has more than 350 million people, so that's not very many homes.
Okay, so Why do we have to build homes? There's like a few more than one reason why we have to build new homes.
Okay, so we've got household formations, right? So people who go out and form households either on their own or with other people. We have people who need new homes because they've outgrown their home or need to downsize, whatever their situation is. We have homes that are destroyed through natural things like fire, flood, tornadoes, hurricanes, whatever. There are homes that are simply functionally obsolete and need to be torn down, which happens.
Yep.
And then we also have eminent domain, right?
What's eminent domain?
Eminent domain is where a governmental entity takes over the property for the greater good of the population. So eminent domain would be things like taking property in order to build a freeway, taking property in order to sell it to a developer to build something where the government gets more tax revenue.
Okay.
We can debate the benefits of that, but that is something that happens. So eminent domain is where government takes property and does something else with it.
Yeah, a company wants to put a manufacturing plant, but they need to expand, and they're going to take over some houses and turn that into more manufacturing facility, right?
Right. So what happens, the company first tries to purchase those homes. If those homeowners don't want to sell, then a lot of times the government will come in and say, you know what, this is economically beneficial to the community because it'll create all these jobs. So we're going to go ahead and force under eminent domain to take your home, and we're going to do something else with it.
Now, before you say, we're going to get the next slide. Before you say, but Todd, the boomers, they're all dying. And aren't we creating more empty houses? No. The rate boomers are dying. Remember, it's take 40 years for the whole baby boom generation to die. We're still growing a population because we have more births, more immigration than we have people dying. Mm-hmm. We have a positive growth. It's estimated the growth rate will continue in the U.S. till about 2080. Mm-hmm. Positive growth rate till about 2080. Okay.
So I can guarantee you in 2080, we will not be making videos.
Probably not. I think we're retired by 2070. That was the goal. We said we'll just make videos for like 60 years or 60 years or so. So 2068 we'll retire.
We won't be making videos in 2070 either.
Okay, here we go. What's weird is our videos will probably, they're somehow people will be able to see these videos and be like, this is crazy. What are they talking about? I can't believe a home was only $400,000 in Vegas. I just bought a starter home for $2 million, right? Okay, so look at this. And you're thinking, oh, yeah, this is terrible, right? Now we'll take the same chart. We'll go all the way back to 1981. So that little red box that you see is what we just looked at. Once you go all the way back to 1981, you realize there was a lot more single family homes built. Mm-hmm. Okay? Now these are single family homes. This does not include multifamily. And if you go all the way back, now $1 million's kind of the number. It actually needs to be more than $1 million, like Wanda said, because the country's growing. But if you see where you had all those years, it was like 12 years in a row where we were above $1 million. And then right toward the end, like 2004, 5, 6, 7, those were the years that caused the housing crash. Why did overbuilding was one of the two major things that caused the housing crash?
So overbuilding, so building more than the market could absorb. And of course, the loan programs. There were lots of loan programs that enabled people who maybe shouldn't have purchased homes to purchase homes. And there was this whole kind of Ponzi scheme, if you will, where people would buy homes with these loans that were predatory, but it was fine because the people were going to buy these homes. By the time they were built, the home would be more than what they were under contract for, and they turn around, sell it, pocket some money, and go do it again. So there was a lot of that. There was this whole kind of round robin thing going on. But remember, these were more homes than the market could absorb. And at some point, the whole thing fell apart, and that's what led to the housing crash. So primarily it was the lending practice, because the lending practices enabled people to buy, and because people could buy, the builders built.
And then builders, remember, they could keep raising prices and sell, so they were incentivized to build as fast as they possibly could and as much as they could. So it was this really terrible cycle that ended in nobody can buy, everyone has to sell, people are getting foreclosed, and the banks started just foreclosing and flooding properties on the market.
Right. So what I remember from those times is that builders would have raffles, or they would have drawings, or people would literally physically camp out in front of the builder's office for a couple of days ahead of a release, because if they drew your name and you weren't in line, they drew the next name, or however they did it. It was just this whole crazy thing. I mean, if you remember the whole line at the Apple store, it was like that, except this was for homes.
Yeah. Okay. The next slide, existing home inventory and new home inventory. This goes back to 2017. That the reason why that little hump is the seasonality. Mm-hmm. All right. You could see this year was kind of goofy because it never really rose. It just kind of crept along. We have data that shows it's fallen. It's starting to fall again in Vegas. Mm-hmm. Last 2 weeks, it started tanking.
Right.
Okay. That dark red line is new home inventory. You can see that it has climbed a bit, but remember, if you go back, if this chart were to go back, 20 years, you would see it would be much higher in previous years. This is the biggest thing causing home prices to go up, right? Is the lack of available homes to purchase.
Right. Lack of inventory is what's causing prices to go up, because even though there are homes that they're staying on the market longer, those homes are maybe in less desirable areas, or the homes themselves are less desirable, or they're not priced appropriately. But a home that is desirable, it's in a desirable area, and is priced appropriately, sells in less than 60 days.
Yep. Okay. Here's the next one. This is a really quick one. Multifamily housing starts. You can see this goes in cycles. We just are finishing a cycle of multifamily building. It's going to decline. Mm-hmm. Multifamily building is going to decline probably for the next few years. It's the only thing that probably kept people live in places to live, because people couldn't afford houses, so they were having to go into apartments and things that were built.
Well, and it's not just affordability, it was just availability as well.
Right. Yeah. Actually, I think it was one of the highest years. In Vegas, the 2021 or 2022 was the most ever number of units built, multifamily units that were completed. If you drive around the freeway, you see them all being built. But.
Right, and they're relatively nice complexes, particularly since they're new. They're nice, new, shiny. They have amenities. They're pretty nice. I mean, what are they going to look like in 10 years? That's to be seen. But right now, they all look very nice.
And the reason why, because it was very cheap money. They're borrowing super cheap money to build these things and rent them out in an environment where rents are rising. So they were incentivized with low borrowing and high rents to go build these things. But the opposite, remember, we've got a good rent chart we're going to show you. The rents are down, meaning the growth in rent is down, and then the borrowing, it's more expensive to borrow. That's why they basically all stopped building.
Right. So, to Todd's point, remember they borrowed the money when the money was inexpensive to borrow, and then it took a while to build. Now they're all built. It's been an expensive time to borrow money, so they haven't borrowed new money to build future units. So that's what's going on there. As far as rents are concerned, remember they started building these things when rents were going up dramatically, so they could see that there was going to be money in it, so it made sense for them to build. Now rents have calmed down a bit, and the price of borrowing has gone up. So for the time being, we don't have as many multifamily units going up.
This is the CPI. This goes back to 2019. You can see prior to 2020, we had this nice chill, 2% chilling out. Pandemic hits, it drops. Now, we had pretty low inflation. The problem was the economy was doing terrible because of the lockdowns and disruptions, and it was hard getting people back to work, and it was we were starting to have problems with the economy. So the Fed said, "Hey, let's kickstart the economy." And what is one of the multiple tools that the Fed has to kickstart economy?
Interest rates.
Yeah, they can also change the reserve rate, which is the amount of the multiplier by which banks can loan based on their deposits. But they haven't touched that in decades, and they don't want to play with that, right? Because that incentivizes the banks to loan more money. They would rather be able to pull the strings.
Well, I think the Fed is more likely to increase the reserve rate rather than decrease it, particularly for small banks.
Right. So you could see here that it actually took about 3 months for the federal funds rate to go to zero before this thing took off. And remember what was happening. We had refis happening. People all of a sudden had more money in their pocket because they were paying less on their mortgage, or they could afford more house. And they're like, hey, I've got more money. And they're spending more money. You now have more money in the chasing goods and services, but we don't have more goods and services.
Right. Well, the stimulus checks had a lot to do with more money chasing fewer goods.
It was actually, I would say it's a perfect storm. You had government cutting, you had stimulus checks, just people just being given money. You had the, decrease in interest rates. And then you had people who were, basically taking this free money and buying things with it.
Well, the other thing that you had is you had people who all they had to do was call up their servicer on their mortgage and say COVID, and all of a sudden they had a free ride regarding their mortgage. They didn't have to make mortgage payments for a certain number of months, and then they could do it again. So that also put more money into the system by allowing people to not make mortgage payments, not have a consequence, or not make rent payments, kind of with the same principle. If you called COVID, then you got a break from your rent for the time being, and you weren't going to be kicked out. So there was that whole thing going on where there was just money coming in from multiple places, not having to make mortgage or rent payments, getting stimulus checks, getting refinancing and getting a lower rate, so having lower payments. So there were all kinds of reasons why there was more money in the system, which got us to the inflationary environment that brought us to the higher interest rates.
Okay, what you notice though is about in the middle of 2022, this train started coming to a stop, and you could see where its interest, the CPI has literally gone down every month. That one little bump was almost all energy. It was a spike in gas prices. Gas prices shot up. That's what caused it. But you could see that there's a downward trend on this thing. And in order for this thing to not go deflationary, they're going to have to start cutting rates. So,
that's a possibility. But, if we kind of take a step back, a little further back, and look kind of at the world a little bit, which we very seldom do on these videos, with what's going on with global trading, we import a lot of goods from Asia, and so does Europe, and global trading is being disrupted. So that could also impact prices for goods, and that may be a factor in inflation for us going forward for the next few months.
You're talking about the Houthis and the Gulf of Aden and the Suez Canal.
Yes.
Yeah, we'll talk about that. But that's like super high level stuff. There's these Houthis who run Yemen are basically targeting any ship that has anything to do with Israel. Even if any goods are going to an Israeli company on it, they go try to shoot missiles at it. So everyone's gone all the way. They're going all the way around Africa to deliver goods to the Mideast.
Right, but it's not just those.
Asia.
I mean, it's a lot of shipping companies that are going all the way around. So it's disrupting shipping
everywhere. Because now these ships can't restock and go somewhere else.
Right.
They're in the water too long. Okay, now we're going to jump over to this is a good one here. This is the 30-year mortgage and federal funds rate. Now, we actually got a couple good charts about this. You could see, that dark blue line is the federal funds rate. That's what the Fed sets the rates. And you can see that line where it was at zero. And then you can see that the raises up as it's raised them. And you could see that the 30-year mortgage has basically followed that. So obviously it has fallen. It shows on here. It's already fallen some. But you could see what's going to happen is the Fed starts dropping rates next year in 2025. There's almost no question that the interest rate for 30-year mortgage is going to drop. Now, this, I think, Juana, because people try to game the system, are going to say, okay, I'm going to buy now while prices haven't gone up a ton and lock in the house and get it, even though the rate is 6.7 or 8 or 9, whatever it is right now, right? Knowing that in 2 years they could probably refi, and have a lower payment rather than waiting 2 years to buy and paying 30, 40, 50,000 more.
Right.
That's just personal opinion.
Right. So yeah, there are a lot of people who are looking at this and saying, "Yep, this is the time." So they're out looking, and we do see that quite a bit. We have quite a few buyers out there looking, but again, we're still in an environment where we have low inventory, not a lot of choices. So buyers are still having a hard time finding the right property.
This is a chart just showing the 10-year treasury, which is highly, highly correlated to the 30-year mortgage. This is basically about the money that gets used to secure mortgages. It's the most closely tied of any risk-free asset for mortgages. And you could see that this is literally, this decline is telling the Fed that, hey, this thing's starting to drop, right? Mm-hmm. So, okay, monthly job gains. Juana, why would we have, in high inflation, we had high job gains, and now we have a slow economy, we have slowing job gains. Why did we have all these job gains in 2021? Like, what was so hot about, why was the economy so hot that we're creating like hundreds of thousands of jobs every month?
Well, I don't know how much we were creating versus restoring.
Okay, so that's true. But let's just say either way, it was more jobs. How do low interest rates cause more jobs? Because the average person doesn't understand that.
Right. So when we have low interest rates, then companies can borrow money less expensively, which allows for expansion. So whether you are a construction company and you can and you've got more work because builders are building, or you are a manufacturing company, you can invest in more equipment and more people to manufacture more goods, or maybe you're a hotel or a restaurant and people are coming back. So you're investing in more employees in order to service your customers. Whatever it is, it's a period of expansion, and it's fueled by and large by having lower borrowing costs so businesses can invest and grow their business.
Companies have this thing called K, which is the letter K, which is their internal cost of capital. And when the cost of capital is low, they tend to want to grow. Mm-hmm. And when the cost of capital is high, they don't want to tend to grow. They tend to want to cut. Well, so you had a period where everybody starting in 2021, all of a sudden, like, airlines started ordering airplanes and people started expanding. Tesla, like, they're a growth company, but other non-growth companies were like adding capacity and adding jobs.
But even other car manufacturers, they were retooling. They were looking at building more EV vehicles versus internal combustion vehicles, which meant retooling their plants, which meant that they borrowed money for all that new equipment. So there are all kinds of different things going on in that way. So just because we've got new jobs in an environment where we have low interest rates doesn't mean that we're going to have less jobs in an environment where we have higher interest rates. So when we have higher interest rates, some companies will lay off. Other companies will try to have cutbacks through attrition, which means that when employees leave, they don't replace them. They try to do more with less. They try to be more efficient. So that allows for the cost of goods to not rise as rapidly.
Okay, this chart shows job gains, and this is since pre-COVID. So this takes out the thing where jobs were lost and the same jobs were added back in that are being counted again, right? What's interesting is if you look at states in dark blue, Idaho, Nevada, Utah, they're small states. So a 9, 10, 11% gain is not a large number of them, but Florida's one of the third or fourth most populous state in the U.S. Yeah. 9%, Texas 9%, even a lot of the South Carolina added, Georgia added. There's a lot of people, and we didn't just add 7% more to the population, right? Where do these people come from?
They were people that either came from other areas, or they were people that maybe were on the sidelines and decided to join the workforce, all kinds of ways.
Yeah, there's actually tens of millions of people within the working age that are not minors, that are just they're voluntarily not in the workforce for whatever reason. Mm-hmm. And some of these people said, you know what? I think I'll go out and get a job doing something.
Right.
And some of them did little basic service jobs. Some of them came back to work at technical jobs. But you can see this is one of the things that's been driving the rise in home prices is people have come back into the workforce. They're making money. And now imagine that you were a one income household and now the spouse went back out and got work. Now you're a 2-income household and your ability to buy a house just literally maybe doubled. Mm-hmm. Because your income went up substantially. Even if it didn't go up substantially, it might have been enough to make the difference to pull the trigger and say, hey, let's stop paying $2,000 a month mortgage is going to be 25, 2,600. Let's just buy since we have the extra income now.
Right.
And do that. Okay. All right. Here's another cool one. This is the one you guys are going to love. This is the home price appreciation since before COVID. So it's 2020 Q1, which is before there was any of that nonsense going on, to the Q3 2023. So 3.5 years. But these numbers are staggering. I mean, Florida 65%, Arizona 58%, even California 38%, Nevada 43%, 47%. The South really did well. Literally every single state had substantial. I think the lowest was the DC, 15%.
Right.
Everywhere else, though, absolutely home appreciation really strong.
Right. So, I mean, to kind of put it in terms that make a lot more sense. So let's say you bought a $500,000 house and let's say you put 10% down. That's $50,000. But your appreciation is on that $500,000, not on the $50,000. So over, what is it, 4 years?
Yeah.
Your home appreciated, $25,000. So that's $25,000 return on your $50,000 because that's all you put down, not counting how much you've bought down your mortgage through principal payments, not counting your tax write-offs and all the other goodies. So kind of look at that and understand that under certain circumstances, homes can be a valid investment. And this is certainly one of those circumstances. Now, we're not saying that this happens everywhere, and we're not saying it happens every 3 or 4 years.
Right.
But it certainly happened in this environment.
One of the things that's funny is I watch these guys who say, you should never buy a house. It should all go in the stock market because it has a higher rate of return. Well, not necessarily. They only take into account appreciation of the home. They never take into account the fact that you have a rental home that you're also getting rent from. Mm-hmm. Once you add in the appreciation and the rent, then even, the stock market may go up 13% that year, but you're guaranteed to get your rent, mm-hmm. and you're almost guaranteed to get your appreciation. It happens 18 out of every 20 years. And then in the down years, when the market's down, you're still up. Mm-hmm. And it's definitely more money than any money market would pay or anything like that. So if you're going to park cash, it's better to park it in real estate than just parking it in something that pays a couple percent, even though right now you get 5%.
Right. So real estate, part of a balanced portfolio, not your sole means of investment.
Absolutely.
Please.
A part of your...
And we're not giving you investment advice. We're just talking
We're not
general.
Financial advisors. We're not giving you legal advice either. Okay. We're not accountants either. Wealth comparison between owners and renters. In 2019, the average renter had a $7,300 dollars of wealth. I think it's actually median. It's median net worth, not average. It's median. Okay. So that means half the people had more, but half had less. So $7,300. 295 was the wealth of a homeowner. Now you could see
295,000.
Right? In 2022, just 3 years later, the renter had gone up $3,000, but the homeowner had gone up $100,000. Massively outperformed 40 times. But you have 40 times the wealth. Predominantly, this is equity in primary residence for most people. That's really what it is. That's why this is such a big difference. Mm-hmm. Pretty substantial. Okay, now here's another very interesting one. Now you're pricing, Todd, this makes no sense. What is this thing? Okay, we've talked about this concept before. This is the spread between the 10-year treasury and the 30-year mortgage. Now, as you can see, that historically it's between 2 and 1.5%. Now, all those spikes were times of uncertainty. The first one toward the left, where that's circled in red, is a great financial crisis. Uncertainty. So the spread between borrowing money getting money at 10-year rates and turning it into 30-year mortgages had to be more because you have to cover potential rise in interest rates. You need to cover that, right? You could see that first one, which is the start of the pandemic, and then the second one, which is today with the inflationary environment, right? Well, two things are going to happen when the Fed drops rates and we get down to more normalcy. There's not as much uncertainty. One is, let's say the Fed's drop rate 2%, 2% total in a year and a half. Mm-hmm. Mortgage rates probably going to closely follow that, right?
Correct.
Okay, so that's a 2% drop in rates. Then let's say we go from this 3% back to to 1.5. You now get another 1 to 1.5 drop in rates. So imagine today's rates 3.5% less, because two things have happened. The federal funds rate has dropped. There's less uncertainty. Now, no, you're not back at 3% rates, but you're maybe at 4.
It's possible.
Yeah, it's possible. You're below 4 for a VA or something, and now you're back to basically right where we were before the pandemic.
Right.
I mean, it's all possible. I'm not saying this is going to happen, but this is sort of the people who said mortgage rates are just going to keep going up. Yeah, probably not. It's not looking that way. I mean, yes, we do have this problem as a country with borrowing and high cost of having to, service the debt.
Right, but that's more of a cultural problem than anything else.
Right.
And what I mean by that is that this is the way we view money as a culture versus other cultures that view debt as something bad and something that they don't get involved with.
Okay, this chart shows all home sales. The orange is resales, the blue is new home sales. And it shows the last 6 years, of course, well, it shows the last 5 years. And then the 2024 forecast, which shows we're going to sell about the same as we sold in 2022, less than the other 3 years, though, but definitely more than this year. They think new sales up 19%, existing home sales up 13%. This will be good news. We need these houses if interest rates drop. Why?
Because that will embolden more buyers to come into the marketplace when interest rates drop, and so they need homes to buy. Because if we don't have these interest rates come down, then we're going to be kind of in the same situation that we've been in, where it's just a tight market. Sellers don't want to sell, and the buyers that are out there are fighting over fewer homes. So new home builders coming online with new homes is a good thing.
Okay. That is it for the slides.
Okay. Lots of slides.
Lots of slides. I thought it was very interesting. A lot of good data. Some of this we've talked about, but I like the one slide that showed the risk and how there was that 3% premium from the 10 to the 30. And that's all starting to go away. The market, that's all market driven, by the way. That's not anybody picking that number.
That, by the way, explains why interest rates have gone down, even though the Fed rate has remained unchanged, because that risk premium is getting smaller and smaller.
The Fed has literally said that we're done with raises. We're probably going to have a couple drops next year. Right. Whether it's 2, 3, 4, it doesn't matter. We can see a return to normalcy. It's like you can see it coming. You don't need to wait until it happens.
Right.
Yep.
All right. So that was hopefully fun, interesting, and you appreciated the slides.
And my jacket. You appreciate the same jacket I've been wearing for the last 320 videos.
So hopefully you liked the video. Please remember to like the video, subscribe, hit the notification bell so you can get notified when the next amazing video comes out. Leave us your real estate related comments. We appreciate them. If you have suggestions for Todd's iPad, go ahead, bring it on.
No, I'll have a new iPad tomorrow.
Okay. All right. So thanks for watching. We'll see you on the next video. Bye.
Bye.